Hi guys, and welcome back to my channel Pips and Profit. I'm glad you made it to the fourth video in this series, which is titled Forex Trading Terminologies. And in this video we are introducing the basic forex trading terminologies, and this is part of a series called Forex Trading for Beginners, where we teach everyone how to trade. Everyone and anyone can trade, and in this video series we are here to prove that. And by the end of this series, I'm promising you that you should no longer be a beginner trader, but at least an amateur and intermediate trader. All right, so straight to the content for today: forex trading terminologies for every beginner. All right, so first amongst the terminologies is what we call pip. You've heard many forex traders mention pips, and what it basically means is an abbreviation for percentage in points. Percentage in points. You don't need to worry yourself about the calculations of how they come about, of how a pip comes about. You just need to understand what it means and interpret it to your forex trading chart. And if you don't get what these terminologies means, another way you can understand it is in usage. And in subsequent videos, we're going to be using these terminologies, which will give you more explanation and enlighten you more on what these terminologies means. Okay, so this video is just for basic definitions of what these terminologies means. So for PIP, what it means is that it's the smallest price movement in a currency pair, usually the 4 decimal points for most currency pair. We're going to do a separate video explaining how to calculate pips and all that. Okay, so you just get an understanding of these terminologies. So when a currency pair moves from one price point to another price point, the difference between those two price points is what we call a pip. For example, if we're trading the Euro USD and the Euro USD moves from a price of 1.3000 to about 1.3001, we say it has moved 1 pip. There's a 1 pip difference between the two. Okay, because currency pairs are not measured by any unit, we use the difference in price as pip. We call the difference in price as pip. So 1 pip move is when price moves from one point to another, and it's usually the fourth decimal point. All right, in this case we have 4 decimal points, 1.30000 as the original price, and price moved 1 decimal point, which is 1.3001. So being that price has moved 1 decimal point, we say there is a 1 pip difference in price. So price has moved 1 pip. If it does a movement from 1.3000 to 1.3005, we say there is a 5 pips movement in price. If it also moves from 1.3000 to 1.3010, we say there is a 10 pips movement in price. Similarly, when it does a movement from 1.3000 to 1.3050, we say there is a 50 pips movement in price, or there's a 50 pips difference in price. And lastly, if it moves from 1.3000 to 1.3100, we say there is a 100 pips difference in price. So if you're taking advantage of price from one point to another, we are calculating that in pips. In the next video, we're going to show you how to calculate pips movement and relate it to price or an actual amount in trading. We're going to do that in the next video. Now, the next concept we want to explain is lot size. And the lot size indicates the size of your trade position. How many units of a particular currency pair do you want to purchase or sell? Because in trading, we're either buying or we're selling. So how many units of a particular currency pair do you want to purchase? Okay, so we have what we call the standard lots, we have the standard lots, we have mini lots, and we have micro lots. For a standard lot, you are purchasing 100,000 units of a particular currency pair. If you're using a mini lot, you are purchasing 10,000 units of that currency pair per one lot. And if you're using a micro lot, you're purchasing 1,000 units of that particular currency pair. Example, if you say you are buying one lot, one standard lot of Euro USD, it means you are trading 100,000 euros. All right, it means you are buying, you're trading 100,000 euros, 100,000 euros, and you want to take advantage of the price movement. Okay, don't worry if this is looking confusing. By the time we are explaining other concepts and using these concepts in actual practice, is going to make more sense to you. So just follow me through and trust me. Okay, so when you say you're buying one lot of Euro USD, means you are actually trading 100,000 Euro USD. Sorry, 100,000 Euro, and you want to take advantage of the price movement from one particular point to another. Don't worry, you'll get this whole thing. Okay. Now, the next terminology we want to explain is spread. Spread is the difference between the buy and the sell price of a particular currency pair. Okay, the difference between the buy price and the sell price. When you're trading the forex market, you're trading on what we call a broker. Now, a broker is a firm or a company that tries to broker your purchase or your negotiation, or let's just call it your business in trying to buy a currency pair or sell a currency pair. Okay, so if you say you want to buy Euro USD, you do not have an actual euro or an actual US dollar in your hands. So what you're going to do is that you're going to fund your account with a broker, which most likely will convert it to whatever currency you wish. Okay, so if you fund a broker with maybe 1,000 Canadian dollar, 1,000 US dollar, 1,000 euro, and you say you want to buy, let's use US dollar for instance, you fund your broker or wallet with 1,000 US dollar, and you want to buy Euro USD. You do not have an actual euro you want to buy. So what your broker is going to do is that they will stand as a middleman to convert your dollar, which is already in your wallet with them. They'll convert it into euro and do the actual purchase for you. They're going to purchase a euro. All right, they're going to do the actual purchase for you. So what the broker does is that they stand as a middleman between you and someone else who is willing to sell. So if, for instance, you say you're buying the Euro USD, what you're actually doing or what you're actually saying you want to do is that you want to buy Euro USD and you want to sell your dollar. Okay, so if you've funded your account with a dollar, that means you want to exchange your dollar for the Euro USD. Remember in the first video I explained this. So if you've not watched the first video, you could go back and watch the first video and get proper understanding of this concept. Okay, and then you come back to this video. Back to what I'm explaining. I said if you want to buy the Euro USD, it means you are saying, take my dollar, I want to buy the euro. And when the price appreciates, I want to sell. All right? So I want to take advantage of the movement in the price points. Okay? So when we now say there is a spread, what a spread means is the difference between what the broker is willing to buy from you and what the broker is willing to sell to you. It's going to make sense when we start using these terminologies in actual practice. Okay? So the difference between the buy and the difference in the sell. So if I say I want to buy the euro, for instance, the Euro USD, there's a particular price that the broker is willing to sell to me at. If I say I want to sell the Euro USD, there is a particular price that the broker is willing to buy from. Okay, so I can't just randomly wake up and say, oh, I want to buy the Euro USD at this particular price. There is always a particular price that the broker will be willing to buy from me from or at, and there's also a particular price the broker is willing to sell at. Okay, so the difference between the buy price and the sell price, we call it the ask and the bid price. The difference in that price is called a spread. And because there is no unit to a currency pair, that spread is indicated by pips. Okay, so an example is if Euro USD has a buy price of 1.300 and sell price of 1.2995, the spread is 5 pips. So what this literally means is that if the buy price of Euro USD or the ask price, buy price and ask price are used interchangeably because they mean the same thing. Okay, so if the buy price or the ask price of Euro USD is 1.3000, that means if I want to sell Euro USD, the broker is willing to buy it at 1.30000. I hope you understand. I'll repeat it again. If I want to sell Euro USD, that means the broker is willing to buy it at 1.3000. If I want to sell Euro USD, in this particular scenario, the broker is willing to buy it at 1.2995. So when I click on the buy option that activates for me is 1.2995. And if I click on the sell option, the sell price that is activated for me is 1.3000. And the spread is the difference in this price. For some brokers, they can offer you what we call a no spread account, okay, where the buy price and the sell price is the same. But for some other brokers, they're going to offer you an account that has a spread on it, where there's a difference between the buy price and the sell price. I hope that is clear. So that is what spread means, right? Another concept I want to explain to you is leverage and margin. Now, leverage allows the trader to control a larger position with a small amount of money. So, for instance, don't worry, I'm going to explain that. Let me explain what margin means so that I'll explain the two of them with one example. Now, margin is the amount of money required to open and maintain a trading position, typically a percentage of the full position size. So the example is this. If you have a leverage of 1:100, that means for every $1,000 you trade, only $10 is required as the margin. So for every $1,000 you trade, the amount that is required to open and maintain a trading position is $10. Okay? So if you're trading with a $1,000 account size, the minimum that you can give up and say, I want to trade this amount, I want to buy Euro USD worth so and so amount, the least you can open is a $10 trade. Okay, so if I have a $1,000 account or a $1,000 capital in my wallet or in my trading account, and I want to trade it, the minimum amount or the minimum amount in terms of units of Euro USD I can purchase or sell at a time is $10. So I can sell $10 worth of Euro USD and wait for it to appreciate, and then I'll take it back. All right, or I can buy $10 worth of Euro USD and wait for the difference in price for me to now sell it. Okay, so the minimum amount that is required for you to open or maintain a trading position in a $1,000 trade with a leverage of 1:100 is $10. Okay, and like I promised, you're going to get the hang of this as we continue. All right, you can watch the video over and over again and you're going to get good understanding of this. All right, now the next concept I want to explain is stop loss and take profit. Now, stop loss is an order to close a position at a predetermined price to limit losses. So if I'm trading my $10, remember the last example I gave, I have a $1,000 account with a 1:100 leverage, and I'm taking a trade of say about $10, which is the minimum I can use with that margin. All right. If I'm trading at $10, if I'm trading $10, I'm purchasing $10 worth of Euro USD. So I'm saying if price doesn't go in my direction, if I want to buy, for instance, for me to make profit, price has to be going up, price has to be appreciating. So if I want to take advantage of that buy, price has to be going up. But if in another occasion price is now going down instead of going up, that means I'm in a loss. So what I'm going to do to limit the amount of losses I can take is by setting a stop loss. So I'm saying if my $1,000 gets to $900, I want to stop that loss. That means I'm willing to take a maximum loss of $100 on that particular trade. So if my $1,000 becomes $900, it's going to automatically stop the trade. So if I buy a certain amount of Euro USD and it has been trading and it's not going in my direction because I'm buying, I expect price to go up, all right, for me to make good profit. For instance, you bought an electronic, say a phone, and you want to sell it. You can't sell it when the price is going down. You want to sell it when the price starts going up. But if peradventure the price starts going down, if you do not sell it in time, you may lose value completely. All right, so say for instance, I buy, for instance, an Apple or a Samsung mobile device for $1,000 and the price gets to $100, I've made profit. But if the price gets to $900 after I bought it at $1,000, that means I'm making a loss of $100. If the price further depreciates to $800, that means I've taken a loss of $200. The price can even depreciate to $0. But for me not to wait until the price has depreciated completely and I lose my whole capital, I can say when the price depreciates to $900, I'm willing to take $100 loss. So what you do in this case, by yourself, you set a stop loss amount. All right, you set a price and say, I don't want price to go below this level. If it goes below this level, take me out of that trade. It's no longer profitable. I'm losing. And this is the maximum amount I want to lose on this trade. Similarly, a take profit order is an order to close a position at a predetermined price to secure profit. So I can also set it. You can set it and go to sleep. And if price gets to any of these levels, it's going to trigger automatically. You don't need to be there to trigger it. Once you set these levels, it's going to trigger automatically. So using the same scenario of an Apple or a Samsung mobile device, I buy it at $1,000 and I say, I want to make a $500 profit on this. I want to make $100 profit on this. So if price gets to $1,100, I've made $100 profit. If that is where I set my take profit at, price is going to, or the broker in this case, is automatically going to help me exit that trade. Okay, so I place a trade to purchase a Samsung device or an Apple device at $1,000. The moment the price keeps ticking up and gets to $1,100, the market is going to take me out automatically. The broker is going to take me out automatically because I've set a predetermined amount of profit. Same thing when I set a predetermined amount of loss. If the market starts going against me, this is the maximum I want to lose. I hope this is clear. We're going to explain that when we go back to look at the charts. I just want to explain these terminologies to you. In subsequent videos, we're going to look at the chart properly and explain all these concepts in the chart. Okay? Now, the last concept we want to explain is long and short. So if you hear traders saying long positions or short positions, what it simply means is that they are buying or selling a particular currency pair. So if I say I'm going long on Euro USD, that means I want to buy Euro USD. And going long, you have to go long at a particular price. So if I say I'm going long on Euro USD at one spot, 1.3000, that means I'm buying Euro USD at 1.3000 and anticipating an increase in price for me to make profit. Okay. Similarly, if I say I'm selling Euro USD at 1.3000, that means I'm anticipating a decrease in value, which will reduce the price of Euro USD. Okay, so if I'm selling at 1.3000, I want to see price go below 1.300 for me to make profit. So a trader will tell you I'm shorting, or I'm longing, or I'm going long, or I'm going short on Euro USD. So whenever we say you're going long in a particular currency pair, it means we are buying it expecting that the value or the price is going to increase. When we say we are going short, it means we are selling a particular currency pair with the expectation that the value will fall. Hope you understand this basic concept. In another video, we're going to look at examples of this concept in an actual chart. Okay, so I hope this video was helpful. If it was, do well to click on the like button and subscribe to this channel if you haven't. Also share this video with your friends. Okay, thank you very much for watching. Hope to see you in the next video. Cheers and God bless, guys.